just before we went on stage, Rich's firm made money off of Circle, hundreds of millions of dollars off of the Circle IPO. So it begs the question, are IPOs back?
Well, I can't think one data point doesn't make a trend yet, but we are very happy for Jeremy Allaire, who's the founder and CEO of Circle, and it did, I think, just start trading just a few minutes ago, and it looks like a good start. I think for both Laela and I, there's a number of companies in the pipeline, both from an S1 perspective, and there's the beginnings of a lot of top of the funnel discussions around M&A as well. And I think it's a lot more active than it was a year or 2 years ago. So I think there are good signs ahead, we think.
But meanwhile, Laela is involved with Stripe, which has at one point wanted to IPO, and now it seems like they're trying to do tender offers instead. And so what's the rationale for companies that are choosing not to IPO, but that can?
Yeah, I think that's been a conversation for a long time, for the last couple of years. I mean, the data shows the average length that companies have stayed public, I think, or before they've gone public, has stretched from what used to be more like 6 or 7 a couple of years ago to more like 10 or 11 now. And I think that just speaks to the availability of capital options that truly generational companies like Stripe have. The private markets are robust. There's a lot of capital available to companies that are operating in big markets that have really strong financial profiles. And I think that capital availability, especially to do things like tender offers, which employee liquidity, for example, used to be a big reason that companies would want to go public. And with the private markets available to fill that need, staying private also has a lot of optionality and positive benefits that I think the best companies have the choice of whether to stay or to go, and that's what you're seeing.
So could Stripe stay private forever, or would they reach a point where they run out of private investors to keep bidding it up? And, you know, wouldn't you think someday they'd want to access the broader scope of people, the retail?
I think forever is a long time, so I doubt that will be the case. And I think, again, at Stripe and many other, I think we have the largest number of really multi-billion-dollar companies that are private, that the public markets are excited to sort of access that growth, access that opportunity. And I think, I doubt it will be forever, but I think what you see is really robust private markets, not just new capital coming in for tender offers, but you're also seeing a real big change in the venture landscape of liquidity of early stage investors selling to later stage or crossover funds. So you're seeing liquidity in the private markets in much more robust ways than you've seen historically. And I think there will be a time that most generational technology companies will choose to go public. There are still advantages, especially in the enterprise space. There's still cheaper availability of capital. So there's a lot of great reasons to go public. But I think with many of these private companies, you're seeing the operating discipline of the public markets happening in the private markets, quarterly investment calls, all the traditional sort of operating infrastructure is happening in these companies. So, you know, the trade-offs are real for the founders that are still trying to innovate at really rapid paces.
And so it's not just IPOs that are starting to come back. M&A, I looked at the data, and we're seeing record unicorn M&A, the most notable example of that being Google Wiz, which was a $32 billion deal. What do you think? Do you have some more big exits coming up in your portfolio, Rich? You
know, Katie, you have good sources, so often you seem to call me in times I cannot comment. But yeah, I do think, you know, top of funnel, as we were talking about out there, I'm sure in both our portfolios, there are a lot more first dates and second dates than ever before. Whether those go, you know, all the way to consummation, we'll see. But there's definitely a lot more activity. I think the change of the administration. I know there's a lot to talk about on that topic, but as relates
tell me more. What do you think?
Well, at least as it relates to the FTC, I think it's perceived as having a little bit more openness to large-scale M&A among certain players. And I think that's opened up the appetite for a number of acquirers to engage, whereas before they were pretty stalled. So yes, I think the second half of this year is going to see a lot more large M&A. That really wasn't the case the couple years before.
What do you think in your portfolio as well? Are you looking for more M&A?
Completely agree with Rich. I think when you look at the leading indicators of, again, both on the public side, number of confidential S1s filed, on the M&A side, the number of conversations happening, we've seen a big uptick in activity. But I would say it's also, like many things, under the covers, a tale of multiple cities. There's the big, the headline M&A that we all love seeing, especially investors and founders. And there's at the big prices in the hottest sectors like security, AI, infrastructure, those type of things. But we're also starting to see what I call a little more rational, accretive M&A. So as we all know, there were hundreds, thousands actually of companies founded or funded during the 2020-21 period. And you're starting to see a lot of those companies that maybe are realizing they're not going to be at the scale to go public, have good strategic relationships with larger acquirers, both public, and then also you're seeing M&A of some of these big private companies we just talked about doing sort of billion-dollar acquisitions. So I think you're seeing more acquirers, you're seeing more rationality in the mindset of some companies that are operating and see a better together story. So just more activity across the board.
Right. And in terms of private companies, there was recently OpenAI bought Johnny Ives' business for $6 billion. You know, historically,
that's a pretty unique one.
Pretty unique one. Okay, what do you think? What do you think about that one? What made it happen?
Well, obviously, you have a generational talent, and you have a direction of where OpenAI has an aspiration to go, and they decided it was worth that generational talent. That's my outside-in view of it. But I was just commenting that we'd love things like that to happen for the torso of our portfolios. It's not realistically happening in that way. I think, if I may just say, I think when you were back in 2022 and 23, a lot of founders and VCs are kind of waiting for the 2021 multiples and valuations to come back. Now that we've gotten to where we are now, 2 years after that, I think reality is starting to set in that that's just not going to come back naturally. And you got to accept the reality of how the market values you at this point. Which, let's be clear, it's not easy to accept that, both as the investor or the founder, but that's starting to happen, and that's why some M&A at reasonable prices is starting to occur.
So they're willing to sell below their last valuation?
In some cases, yes. In some cases, if you realize you're never going to hit that high watermark again, there's some pain involved in that, again, for the investor and for the management team. But yeah, I think that's the only way this inventory of the high-priced multi-unicorns that might not be worth that anymore are going to get cleared out ultimately.
Yeah, Laela, you were nodding. So you're saying that founders are maybe not as much in denial anymore. And would they also do down round IPOs, like Chime coming up?
I think we've seen several down round IPOs. I mean, I think if we look at how the cycle played through post 2021, Rich and I sat on a public board together. I think the reality is public companies had to face the music immediately, right? All of a sudden, the market has changed. You cycle through that in a quarter or two. You deal with employee compensation. You deal with realistic M&A targets. You deal with what the financial profile you have to run the company to. The private markets, that type of macro change just takes much longer to flow through. But I mean, we've looked at several IPOs that have happened that are, most of them were below the peak 2021 valuations. And I think if you looked at M&A, in many cases, that's the case as well. And that still is a great outcome for founders, teams, investors in many cases. The down round, can feel more like an emotional thing than a real punitive financial thing or the reality of the business. And I think we're starting to see that flow through in much more significant ways, I think, across the ecosystem.
So of the 1,000 unicorns that have yet to exit, what do you think is the most common scenario? What are you seeing here? Because there's 1,000 companies, for those of you who don't know, that are valued at $1 billion on paper, but that doesn't mean much until they have a liquidity event. So are some of them going to be zombies? That's what I hear. Zombie unicorns is the term.
I mean, some will. If you just look at the math, if you take 1,000, right? What was it? I think the number of tech IPOs, you probably know this better than me, in 2021 was around 90 or something like that.
Plus the SPACs.
Plus the SPACs, which I don't think we'll have a comeback of those.
Put those in your
It's a dirty word at this point. It's a better word.
And then there's been a handful this year. Hopefully, as Rich said, we'll begin to see that accelerate. There's I don't know the official number. When you talk to bankers and you look at our portfolios, there's certainly many that are S1 ready. But that is, even if we took a peak 100 and you thought of 1,000 out there, there are just a small minority of these companies, I think, that will be standalone public companies. So you'll start to see various activity. You'll start to see some that I think probably will be more what people are calling zombie unicorns that are able to use the cash they've already raised, but to kind of operate at a subscale of a public company, but profitable, so at low EBITDA margins, but can go on indefinitely. I think you'll see consolidation, and you're already starting to see some of that. And then I think you'll see the rational M&A that we're talking about, where people really come to terms with the more rational valuation of the company, and you'll see more M&A activity. But that will take, as we talked about on the private sector trends playing out, I think it will take a long time. And a lot of it depends on the culture of the company, the founder, whether they can really retain and recruit talent to keep that momentum. And I think a lot of those stories are starting to unfold.
Just build on Laela's comment, and fully agree, just maybe estimate some numbers to say, I think maybe out of that 1,000, 20% fully die, they end, and they don't get
20% of unicorns are going to die.
I think 20% of the 1,000 unicorns will not ultimately make money. Those are your words. I'm just going to say, and then I think 20 to 25% ultimately will succeed in some form, whether it's money-making M&A or ultimately independence from an IPO perspective. And then I think you got about half, 50, 55% of the middle that's stuck. And some of those will ultimately have reality set in, and you have attractive M&A occur at some realistic price, and some will be a bit zombie-ish of that middle 55% and grind on for a while and sort of stay in that category. But I think you have good outcomes for maybe a quarter, I think, from a money-making perspective off the 2021 peak.
Mm-hmm. So you mentioned earlier, you have to retain talent. What are they doing? Because a big part of poaching employees from Google, for example, is you say, oh, well, we're private. We can go up in value, and someday we'll IPO, and your stock is going to be worth so much money. So how do you even get these top people to work at these unicorns at this point?
I think talent is a really important question. And it really varies by companies. I think one of the things we haven't talked too much about, but we're at a tech conference 2025, so we have to say AI at least 15 times, or Rich and I won't get invited back. And so there are these big sort of things like AI that really are completely new vectors of transformation, potential tailwinds. I do think these are founders, they're innovators, they're entrepreneurs. So a lot of these companies that have a lot of funding are trying to reinvent second waves and think about how they can take the innovation of whatever they created to get some decent amount of funding in 2021 and continue to innovate. And if they have good cultures and good talent, I think you're seeing actually more retention in some cases than we did in the peak 2021 bubble, when jobs were everywhere, and there was so much money flying around that compensation wars were a fairly frequent thing. So in some ways, I think if the founder vision is still there and this sort of articulation of a strategy that employees believe in, we're seeing retention. In other cases, like so many snowball effects in a downward spiral, I think it is hard to retain great employees when the business results are not coming through. So I think in those situations, you're starting to see the reality of the leadership team having to face the music potentially earlier and figure out some of these M&A or alternative offers, because it's hard to keep talent, hard to keep customers, hard to keep the business afloat.
So an employer's market, do you think that means we're headed to recession? And do you even care if you invest on a 10-year time horizon as a VC?
I don't think realistically, especially when we do truly early investments, it takes 12 to 15 years in order for these companies to get to Circle's moment.
15, is that what you
today.
do your LPs now?
Well, sometimes you have M&A sooner in terms of some of the most attractive companies that emerge in the portfolio. But yes, to take a company from Series A to being public, and then obviously you have lockup, and when you choose to distribute, there can be a very, very long periods of time. So I think it's not a short-term game at all.
And your only LP is Google, so you have less pressure in that sense. But there are many, many venture firms that aren't lucky like that, or maybe it's not luck, but a lot of the emerging smaller funds are going away. We looked at the data and we saw that, if you're not Accel or CapitalG or a top tier firm, there's not a lot of money available right now. What are the ramifications for the broader ecosystem if emerging funds go away?
Okay. Challenge the premise of that?
You want to challenge it?
I don't think I necessarily
Am I wrong?
see that, right? I think well, first of all, broadly, you have a lot of questions about performance about big private equity. And so when a lot of these endowments are looking at how much they're allocating to alts, we see a lot of people thinking about how to maybe reduce somewhat their exposure to large private equity and looking for other places to deploy. Sometimes that's mid-market, and sometimes that's our world of growth and VC tech investing. So we do see a lot of capital trying to come down to this market. And people that did not used to be LPs of venture capital back 15 years ago, sovereign wealth, Japanese insurance, different forms of Canadian pension, as 3 examples. In the last 5 years, we've gotten very active, sort of coming in to invest in general partnerships in the VC world. And so I don't know, I wish some degree that, I wish that some capital was leaving the VC world because it would make it easier for us competitively, but I don't know that I see that.
So I think, to be clear, there's the top funds, which are raising more money than ever in larger funds. And, as you know, there's new LPs coming in. And then there's also the smaller emerging funds that may not experience the same good fortune when they're trying to raise.
Yeah, I think potentially what you're alluding to, Katie, I did see a stat somewhere that I think 75% of capital that has come in, LP capital that's come into the ecosystem the past year, has gone into the top 30 funds. So It's sort of a concentration issue. And that makes sense to me, and the reason why. So as you mentioned, we feel fortunate at CapitalG, Google and Alphabet are a single LP, but we invest for financial return. We don't invest for strategic reasons. And that has been a big advantage to us because we have a robust set of advisors inside of Google and Alphabet that help us in diligence, especially in areas like AI, and most importantly, help our companies post-investment. And the reason I mention that is venture has become very competitive, and not just in the last year, but over the past decade, increasingly competitive. And I think that's what brings in what Rich is speaking to, which is just there's been a lot of capital in the ecosystem. So during that 10 years, there were a lot of new fund managers that came, and then a lot of the biggest funds just got a lot more capital. So everyone is competing very hard for the very best deals. So there's concentration of capital, and then what we've seen is real scale advantage in the big winners. Everyone wants to be in the Stripes and Databricks and of the world, and has to figure out how to differentiate. So I think that a lot of the funds the biggest funds have been successful in getting in the winners, and LPs are excited to continue to double down on those platforms, and those platforms are having to increasingly differentiate to win the very best deals. So I think we are seeing sort of scale and a flight to quality in both the investment side and on the fund management side as a general trend.
Is there too much capital in the ecosystem relative to the opportunity? And is that going to cause more bubbles?
The perspective I think one has on that question is a function of where you sit. I think stepping back, it's a great time to be an entrepreneur in this ecosystem that we're all, lucky to be part of. I mean, the amount of technology disruption and the degree of GDP impact that's going to have, and the amount of capital available to fund it has never been higher than ever before. So from an entrepreneur's perspective, it's awesome. From a venture capitalist perspective, it does feel a very competitive market. And so I think as that market is highly competitive, it will ultimately affect returns in the category. And I think we're seeing some of that at different stages. Maybe the later stage of the venture capital market certainly has that. Now, depending on whether you're the LP or the GP or the entrepreneur, you have a different view of your question. I think broadly it's good for the ecosystem that there's this much capital chasing these opportunities.